here, this adjustment will not be included here because we are given the profit after tax from the continuing operations. Remember, in this case, I said a discontinued operation is a component of an entity which has been discontinued. For example, a company had a number of branches, but because one of the branches has been making losses, it has been closed down. It is a discontinued operation. In case of a parent company may be having various subsidiaries, and because one of the subsidiaries is making losses, that subsidiary has been disposed, has been sold by the parent company. It is a discontinued operation. So we said in computation of both the basic and also diluted earnings per share, we totally exclude any profit or loss from discontinued operation. We only use the profit or loss from the continuing operation. So meaning that in this case, we don't have any loss because this pure profit from continuing operations. Then in this case, we need to check whether this company had issued preference shares. Well, there are some preference shares which were issued. But also there is something which you said is very, very important, and you must remember that throughout. In case the company had issued preference shares, and the preference shares issued by the company, they are redeemable, we said never make a mistake of deducting their dividends here, because we said redeemable preference shares, this to the company is like a debt capital, because these are preference shares once issued by the company has to redeem them back. So this is like a debt capital. And therefore, we say the dividends in relation to the redeemable preference shares, those dividends are basically classified as part of the finance cost, And therefore, in arriving at this particular profit, which we have here, all expenses, including the finance cost, have been what? Deducted. So in case the preference shares issued by the company are redeemable, don't less their dividends there. Yes. Now, in our question in paragraph 1, specifically sentence 1, we are told on 1st January 2023, which is basically at the start of the current year, 𝐻𝐶 Limited had initial 43.2 million ordinary shares of 𝐻𝐿 par value and 12% convertible redeemable preference shares of 𝐻𝐿 par value. Now, who can tell us? Are we going to less the preference dividends for those preference shares here? Yes or no? Are we going to less the dividends for those preference shares here? Are we going to less them here? Are we going to less them here? Yes or no? Automatically no. Automatically no. Reason being, those preference shares, you can see they are redeemable. They are what? Redeemable. So if they are redeemable, their dividends were included as part of the finance cost. Finance cost, we know, is an expense, which is one of the expenses which has already been deducted in arriving at that word profit. So in that case, we will not less those particular those dividends there. Then in this case, we are not dealing with a group of companies. This is a single company. So meaning that here equally we don't have any profit attributable to the NCI. We don't have profit attributable to the NCI. So the PATOS, the profit attributable to ordinary shareholders, therefore, remain the same, 201,600,000. So we already have the PATOS. Then we need to move and compute the one-offs, the weighted average number of ordinary shares. How do we compute this one? We say to compute this, we take into account the ordinary shares which had been issued at the start. Automatically, this year started on 1st of January 2023 and basically ended on 31st of December 2023. So how many ordinary shares had been issued by the company at the start? And then we add the other shares which were issued during that year. So therefore, we start with the shares which had been issued, the number of ordinary shares which had been issued at the start of the year. And basically, we refer to this as the balance brought down. The balance brought down. So the shares which were issued, the ordinary shares which were issued by the company at the start of the year, we have this within paragraph 1. Within paragraph 1, sentence 1, we are told on 1st January 2023, 𝐻𝐶 Limited had in issue 43.2 million ordinary shares of 𝐻𝐿. These are the shares which in other terms had been issued by the company at the start of the year, 43.2 million. And it's very, very important for you to check whatever you're given here, whether this is the share capital or whether these are the number of shares. If you check 43.2, these are ordinary shares. But if, for example, we are told the company had a share capital of 43.2 shilling 43.2. Then take into account we have the word shilling. Automatically, this would not be the shares, but this would be the value of the shares. To determine the number of shares, you take this amount, you divide that with the par value of 10. But in our case, you can see 43.2 are the number of shares, and the number of shares. Because this is basically another area whereby the examiner tried to catch you. Instead of giving you the number of shares issued, he will give you the share capital. Shillings, like in this case, we are told shillings 43.2, which would not be the shares, but the share capital. For you to get the shares, divide that with the par value. So we are done with that. And then the transactions which took place during the current year for the issue of shares, that is something which is given in the additional information, note 1, note 2, 3, and 4. So can we go to note number 1? In note number 1, you're told on 1st of April 2023, the company invited the current ordinary shareholders to subscribe for a right issue on the basis of 2 shares for every 3 shares held at concessionary price of shillings 15, shillings 15, when the market price on the combined basis was shillings 20. So basically, we are told on 1st of April 2023, the company invited the current shareholders to subscribe for something called the right issue. I hope you can see this particular concept of right issue. This is something we have come across in all questions. This is the 3rd question we are doing, and all the questions we have done, we have come across that concept of the right issue. Because I said this is one of the concepts majority of the students will get it wrong. That's why you can see it is tested in almost all questions for earnings per share. Now, what we say is that a right issue in this requires